The U.S. economy's health is steadily recovering. There are signs across various industries of revitalized demand by consumers. Zacks chief equity strategist and economist John Blank is here to elaborate now. John, you say inflation risk is much ado about nothing. How so?
Well, Terry, we look back over the last 25 years. In general, there is a cyclical move to the core consumer price inflation rate during periods like this when the economy is warming up. But it's a move that contains itself fairly consistently, and you rarely see a move above 2.5% on the CPI. And that translates back into the 10-year rate for the Treasury, which basically reflects that when there is no Federal Reserve interest rate involved. So what I think is basically, yes, we have a lot of stimulus coming into people's paychecks, but it's not necessarily going into the economy in such a fashion that we can get inflation risk. We've got a lot of people unemployed still. We've got a long ways to go before wages go up, and only consistent push from wages to consumer prices do you get inflation. So it's just a lot more premature than people think about this worry about inflation.
In your latest economic outlook, you bring up the fact that the velocity of money entering the economy has dramatically decreased due to a potential savings glut by consumers. And during the pandemic lockdown, that seems to have been the case. As things open up more and consumer spending accelerates, do you expect inflation to spike up then?
Transitorily, yes. I think you can expect more spending. We're already seeing, particularly among the millennials, in the credit card spending they're putting on when they got these checks. But generally speaking, this is still not likely to put the consumer spending on a permanent path higher. So it just could be you see that some particular prices are going to rise, but not across the board, and certainly not in areas like rents where people are still moving back into cities and rents are pretty low. So again, we've got an issue where people are accelerating their ideas in front of the data, and the Fed and everybody needs to slow down and realize this is going to take us some time.
Is there any way at this point to tell when the post-COVID era begins? And are traders already pricing that in?
Well, you hit the nail on the head. I mean, the post-COVID era has begun in traders' minds, and the true post-COVID era probably is going to be found somewhere out in October and beyond. And outside the United States, it might be 2022. So this is the thing. The traders are certainly pricing 2022 in now, not 2021. And the post-COVID era depends on what you're talking about. Certainly the United States, places like Israel, places like Chile, places like the UK are leading it.
What are you looking for U.S. GDP growth this year?
Yeah, I think Goldman's right about a 7% or 8% number, but that's a year-on-year number. That's not going to reflect the strength of the demand. The way I would phrase it for people is 4.2% is full employment in this economy for the household unemployment rate. And that's what you want to look at. If we get to a real strong economy, we're going to be near that unemployment rate. And that's how you can back in the actual level of growth, not the GDP growth rate.
U.S. Treasury yield curve has been rising, yet you say what the Fed and U.S. bond markets are reflecting is not necessarily going on outside the U.S. Why the divergence?
Really, Terry, it's down to two things. One is our vaccination programs are, around 130 million doses on I speak on March the 25th. So in 2 months in the new administration, we're getting a lot of vaccines out of the United States, and that's taking the herd immunity up quickly. And places like Chile, Israel, and the UK are doing similarly. The rest of the world, frankly, outside of Asia, is not really on board yet. So this is a lot of the divergence. The other divergence is the amount of stimulus that fiscal spending authorities in various parts of the world are putting on the books. The United States leading the way in that regard. And so we are seeing our treasury markets respond to that. Other countries which are not doing this are not doing the same thing in their treasury markets, and that's the divergence.
So why is this worth noting, and what is going to be the impact on the global economic growth?
Well, we'll find out from the IMF in the next few quarterly updates from them. But what I would think is that they're going to hold off on putting up the global economic growth rate until they see the vaccination numbers improve in places like Europe, places like Australia, places like Russia, places like Africa, places like South America outside of Chile, particularly Brazil, which is doing a really poor job on vaccination.
So it's going to put a damper on global economic growth.
Well, yes, it's going to put a damper on expectations, and that's really what the market cares about. And until the IMF starts upgrading global growth, the market's not going to buy it. And we're seeing that in emerging market stocks that are selling off right now, waiting on a turn that may be further out than people want to believe.
Here are a few strong buy stocks you're keeping an eye on, John. Rocket Companies, Skyworks Solutions, and Ubiquity.
Yeah, these are three very strongly ranked names at the current moment. We're talking on March the 25th. One, Rocket Companies. They're based in Detroit. This is basically all intents and purposes a mortgage company, but it's got really strong ratings across the board. Zach's number one rank, a B for value, a B for growth, and a B for momentum, which gives us a total score of A for long term. So this stock is looking really nice. It did a big spike on earnings, but now it's back down to $22 a share. You know, this is a nice stock to look into for a housing play. And then you've got Skyworks Solution, which is another number one ranked stock, but this was in the tech space. This is one of these babies that gets thrown out with the backwater. This one can be in the semiconductor area, but what it does is it does semiconductor signals and enable wireless connectivity. So this is, in the iPhone space kind of thing. And if you get a nice sell-off here, you can get a nice, play going on. It's a number one ranked stock, D for value because it's a momentum stock, but an A for growth. And so you got to like a stock like this on this selling of tech stocks generally. Just wait on this one. Ubiquity is very similar, a number one ranked stock with an F for value because it's in a hot space, $335 a share, but an A for growth. And again, it hasn't sold off a lot. It went from about 360 to 335, 340. I would wait a lot more on this pullback on a name like this. But again, if you're looking for names that have support from analysts for the growth on the back end of the selling, you got to like Skyworks, ticker SWKS, and you have to like Ubiquity, ticker UI.
And that's the latest on the global economic situation from our chief equity strategist and economist, John Blank. As always, with John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.